Are you 100% sure that you're not missing out on any tax breaks? A lot of people already know a good amount on how to pay less tax by using things like registered accounts, tax deductions and credits such as childcare expense, medical expense, or donations. And that's because everyone already has talked about the same topic, including myself. So instead of repeating what you already know, after working with hundreds of clients, I've compiled a list of 17 less talked about and often overlooked things that can help you avoid taxes. But to put simply, there's basically 5 categories that it falls under based on the situation you're in. Number 1 is investments. A friend once asked me when he should sell his investments because he was having a headache dealing with all the investment taxes. When you're investing outside the registered accounts such as RSP, TFSA, FHSA, and RESP, it means you're investing in a registered account. And this means the ups and downs will be subject to capital gain or loss taxes when you sell the investments. The first thing to know here is capital losses. Capital losses can offset capital gains in the same tax year. So if you sold investment A while it was up and made money from it, you would expect a capital gains tax resulting from that sale. But if you had another investment, let's call that investment B, and it's down right now, then you could sell the investment B before year end to intentionally incur a capital loss to offset the capital gains of investment A. There is a fancy term for this strategy, and it's called tax loss harvesting. One caveat is when you're claiming capital loss in this way, you cannot buy the same investment within 30 days of the sale. Because when you do, the CRA will consider it a superficial loss and will disallow your capital loss claim. So whenever you're selling a portion of your investment at a gain, it's a good opportunity to review your portfolio to see if there's any rebalancing that you could do while taking advantage of tax loss harvesting. But that's not the only way you can use capital losses. Your capital loss can also be carried backwards or forwards into the other tax years. In the case of carrying back, you can do that up to the previous 3 years. So if you had a capital gain in any of the past 3 years, then you can use the capital loss to offset those gains and get a tax refund back. On the flip side, when you're carrying forward, you can actually do that indefinitely. And CRA automatically keeps a record of all the capital losses you've incurred in all the previous years. These amounts are recorded on your notice of assessment. So it's always a good idea to attach a copy of your NOA and submit it to your accountant when it comes tax season, so that they can check if you have any carry forwards available to use. Another thing you should know about investments is the new capital tax change of 2024. For the past 20 years, capital gains have been taxed at 50% inclusion rate. Let's look at a simple example here and see how it works. Let's say you sold an investment property and have a capital gain of 500K. When the inclusion rate is 50%, it means 50% of that would be included into total income and get taxed. So 250K would be added onto your taxable income and be taxed at your highest marginal tax bracket. But under the new rules that came into effect in 2024, the first 250K would still be taxed at the 50% inclusion rate, but capital gains above this 250K threshold would now be taxed at a 67% inclusion rate. Using the same example, if you have capital gain of 500K, the first 250K would still have a 50% inclusion rate, so 120K. Then the remaining 250K would be taxed at a 67% inclusion rate, so 167K. So in total, we would have 190K added onto your taxable income. The difference between the old rule and the new rule is 42K in taxable income or 22K in additional taxes according to the BC tax rates. Now this doesn't affect the majority of Canadians, but for those with rental properties, it's super important to plan ahead and do thorough tax planning before you decide to sell. For corporations, however, they will not get the 250K threshold, and instead, all capital gains would be taxed at the new 67% inclusion rate. Because of this, it changes the whole corporate tax integration. So for the first 250K of capital gains, you will actually be much better off to hold the assets personally rather than investing it inside your corporation. This also makes RSP and TFSA a lot more attractive than before for corporate owners. The next category is housing. There are 4 tax credits here that we should know of. The first one is home buyer's amount. When you buy your first home you intend to live in, aka your principal residence, this will give you a tax savings of $500. For the purpose of this credit, you're considered a first-time home buyer as long as you did not live in a home that's owned by either you or your spouse or common law partner in the previous 4 calendar years. So this means that if you've purchased a property and have always rented it out and never lived in it yourself, then you are also considered a first-time home buyer. So when you buy your home that you actually live in, then you can claim this credit as well. One note here is if you're buying a property with a spouse, then the both of you can only claim a total of $10K. So either one of you can claim the $10K, or you can choose to split it up and each of you claim $5K. In terms of the amount of tax saving though, it actually makes zero difference how you claim it, because this tax credit is not dependent on income levels. So no matter how you claim it, you're still gonna end up with $1,500 of tax savings. Next is the BC Renter Tax Credit. Now, as the name suggests, it is only available for people in BC, and specifically is for those who are renting and earn less than 80K of income. For this credit, if you make less than 60K, then you get the full $400 of tax credit. And if you make somewhere between 60 to 80K, then you'll get a reduced amount. Another important requirement here is that you must have paid for at least 6 months of rent out of the year. So if you only rented out for 5 months before you moved into your newly purchased home, then unfortunately you would be missing out on this credit. And if you're in Ontario, then you might qualify for the Ontario Energy and Property Tax Credit. This is a credit for low to moderate income families who rent or pay property tax for their principal residence. The maximum you could get here is $1,248 or $1,421 for seniors. Next is the Home Accessibility Tax Credit. This credit is more situational, but is for those of you who've made renovations to your home to improve the accessibility for either a senior or for someone who's disabled. And with this, you can claim up to $20K in expenses. This is a great way to save some taxes while making your home a safer place for someone you care about. The tax credit from this is 15% off the expense amount. So if you claim the maximum of $20K, then that would mean a tax saving of $3,000. But that's not all. If the expense also qualifies as a medical tax credit, then you can claim the same expense twice under both the medical expense tax credit and the home accessibility tax credit. The next category is related to your work. One of the tax deductions we could claim is the professional development and union dues. Some union fees are already included in your T4, but other times they might not be included. For the fees that are not included, the key is that they must be required to practice in your profession. And it also must be an out-of-pocket expense for you and is not being reimbursed by your employer. Next is self-employed income splitting. When you're self-employed or doing freelance work, you can write off business expenses. And one of the business expenses you could use as a way to income split is hiring someone for contract work. So you can consider hiring your family member for some of the work that's required in your business. This way you can split your income with them by paying a reasonable amount for their work. Basically, the high income individual will hire a family member to work and they can claim the amount paid as a tax deduction. As for the family member who's getting paid, they will need to report that income as self-employed income. Plus, they can also write off business expense as well. You should also document the detailed job description and responsibilities and have some ways such as timesheets to track the actual work. So when the CRA asks, you can show them that you're doing legitimate work and not just using it as a way to split income. Next is moving expenses. This is a tax deduction you can claim if you moved at least 40 kilometers closer to your new job or school. So for example, if you live in Vancouver downtown and you got a new job offer that requires you to work in Langley, then when you move from Vancouver to Langley, you would qualify for moving expenses because the distance from Vancouver to Langley is more than 40 kilometers. This is the list of moving expenses you could claim, such as transportation and storage, temporary accommodations, travel expenses, and even the cost of selling your old home and buying your new home. Also, if you didn't have enough income to claim all of your moving expenses in that year, the unused amounts can be carried forward to offset future taxes. Whenever you're claiming these expenses, be sure to keep a good record of all the receipts, because CRA may request for them 7 years past your claim. The next category is if you're a student or a parent. The first thing to know here is how tuition credits work. Most people already know that when you study in a post-secondary program in Canada, you'll receive a T2202 tax form from the university to report on your tax return. But did you know that you can also qualify for tuition credits even if you're studying outside of Canada? The tricky part here is a university outside of Canada is not going to by default send you a tax form to let you claim tuition credits. So you would need to be proactive to ask them yourself to complete a T11 form so you can make the tuition claim on your tax return. Also, a tuition credit is not limited to studying for a full degree or a diploma. When you've paid for exam fees to practice in your profession or trade, you could also claim these for tuition credits. And this is great especially for people who are in the medical field, because they usually spend thousands of dollars to get their medical license. The tax savings you get from tuition credits is 15% on federal taxes, plus the lowest tax rate on provincial taxes. So for example, if we had 10,000 of tuition credits, we would take that 10,000 times 15%, that would give us a 1,500 in federal tax savings. Then we take the same 10,000 times 5.06%, which is the lowest tax rate in BC, then that will equal to $506. And when we add up the total, the tax saving will end up being $2,006. One thing to note here is tuition credits must be claimed on your tax return in the same year that you paid for the tuition. This means that while you're in school, it's a good idea to file your taxes, even though you have no income to report. But what if you already owe zero taxes? In that case, all the unused tuition credits will be carried forward indefinitely. And this is why fresh grads will see a huge tax refund in the first 2 years of work. This will definitely give them a head start to save up for their future goals. But just remember that tuition credits won't last too long. And once you run out, your tax refund is going to drop back to its normal levels, which is maybe a couple $100s. So this cannot replace proper tax planning if you want to reach your financial goals as soon as possible. And for parents who pay for their kids' education, there is an option for the student to transfer up to 5,000 of the current year's unused tuition credits to their parents for some tax savings. Spouses can also do the same thing for each other in terms of transferring tuition. Sometimes clients ask me if it's better to hold off claiming their tuition credits because they want to save it for later years when they expect to have a higher income. This is a common misconception, because the tax savings we get from tuition credits is only based on the lowest federal and provincial tax rates. So no matter what your income level is, the amount of tax savings you get is going to be exactly the same. So it's always better to use it up as soon as you can so you can get your tax refund earlier and use it to grow your wealth sooner. The next thing to know is the Canada Training Credit. This is a tax credit you could claim to get a much bigger tax saving by using up a portion of your federal tuition credits. The way it works is this. When you're between 25 and 65 and you're earning between 10,000 to 150,000, then this credit will start accumulating for you at a rate of $250 per year, up to a lifetime maximum of $5,000. Once you've accumulated an amount, in the year that you go to school and you claim tuition credits, you can use 50% of that current year's tuition amount to claim the Canada Training Credit instead. Let me explain, because it's actually a very big difference in terms of tax savings. Let's say, for example, if you have 1,000 of CTC accumulated and you have $2,000 of tuition credits to claim. Without CTC, we would have a tax saving of $401 according to BC tax rates. But by claiming $1,000 of CTC, we would have a tax saving of $1,251. That's triple the amount of tax saving by claiming CTC. This is also another reason why it's always a good idea to provide your notice of assessment to your accountant, because these numbers would be available on your notice of assessment. Finally, when it comes to students, how can we not talk about the best registered account for saving for education? And that is the RESP, or Registered Education Savings Plan. This account is for Canadians who want to save for their kids' education. And even though it doesn't give you the tax savings like RSP or FHSA, it's still worth mentioning here because the government does give a generous 20% grant when you make any contributions into it. This account allows us to hold investment inside and grow it tax-free. The maximum grant you can receive per year is $500, and there is a lifetime maximum of $7,200 per child. So for example, to take the most advantage out of this account, you would want to contribute $2,500 into the RESP every year. Then you'll get a 20% grant on that, which is going to be deposited into the RESP account for you to invest and grow for your child's education. Aside from the 20% grant, some provinces have their own education grants as well. For example, there's the BC Education and Savings Grant that provides an additional one-time grant of $1,200. So what happens when you withdraw money from it? Do you get taxed? Well, it depends. When you withdraw the money after your child is enrolled in a post-secondary program, it will be taxed much more favorably. There's 3 types of withdrawals that we can make from the RESP, and each is taxed very differently. The first is the refund of contributions. This is basically the amount that you originally contributed, and you can withdraw that out tax-free. The second type is the Education Assistance Payments, or EAP for short. This includes the money from the grants and also the investment gains. And it has a withdrawal limit of $8,000 during the first 13 weeks of schooling. After the first 13 weeks, any amount of EAP can be withdrawn. Now, the tax treatment for EAP is that it's going to be taxable under the student. And that's good because most students have a lower income compared to their parents. So even if there is tax to be paid, it's going to be a lot less. But you may not want to withdraw everything all at once in 1 year because that might bump the student into a higher tax bracket. If the student has no other income besides the EAP, then they could withdraw $15,000 with minimal taxes because of the basic personal amount tax credits. But you might be wondering, what if my kid decides not to go through school and just wants to be a full-time YouTuber instead? Well, in this case, you could draw the benefits and investment gains as an accumulated income payment, or AIP for short. These terms are a mouthful even for me as a financial planner. And this type of withdrawal means that the amounts will be taxable under the subscriber or the parent instead of being taxed under the student. And the worst part is that there's going to be an additional 20% tax. This would result in a much bigger tax bill, so it's definitely not the most ideal setup. But there is a way to avoid tax here that most people don't know. And that is you could transfer the AIP to a RSP or a spousal RSP account. The maximum you could transfer is $50,000 as long as you have enough RSP contribution room. And by doing this, you can avoid the taxes completely and let your investments continue to grow tax-free until you eventually withdraw. But you will need to return the government grants and their earnings back to the government. Finally, the last category is seniors. The first thing we should know when we're a senior is that we have something called the pension income credit. Now, what qualifies for this credit is payments from company pension or certain annuities. And you can claim a tax credit of up to $2,000 of eligible pension income. RSP withdrawals do not qualify for this credit, but when you turn the RSP into an annuity or an RRIF, and you can claim this tax credit. But the numbers that we claim here does not mean the actual dollar amount of tax savings that you get. The tax rate for federal tax credits like this is 15%. So this $2,000 credit would translate to a $300 tax saving. Next thing to know is pension income splitting. Now, retirees can split up to 50% of the eligible pension income with a spouse. So this is a great way to reduce the family taxes by splitting income to a lower income spouse. Not only that, but the spouse can also claim the pension income credit on their own. So your family will get double the pension credit. Next is the Canada Caregiver Credit. This credit actually replaces 3 previous credits that you may have heard about. And that is the caregiver amount for infirm dependents, as well as the family caregiver amount. And by consolidating these 3 credits into one, it will make it easier for the average Canadian to claim this credit, because it's a lot easier to understand the qualifying requirements. Basically, you can claim this credit if you support a spouse with physical or mental impairment. In the case here, a dependent means it's someone who's depending on your support and relies on you regularly to provide them with the basic necessities of life, such as shelter, food, or clothing. Now, the amount that we can claim depends on the relationship. For a spouse, you can claim a credit of $2,499 plus an additional amount of up to $7,999 if their net income is between $8,000 to $26,000. And for someone who's a dependent 18 years or older, you can basically claim the same amount. So the $2,499 plus the $7,999 depending on their income. And finally, if it's a dependent under the age of 18, then you can only claim $2,499. Remember, the tax rate for federal tax credits like this is 15%. So this translates to $374 up to $1,574 in tax savings. And number 4 is the disability tax credit. People with prolonged and severe physical or mental impairment can qualify for this. To apply for this credit, you do need to get a medical practitioner to certify your impairment. Once you're approved, you can claim the federal amount of $9,428 or $15,006 for children under 18. This translates to a tax saving of $1,414 or $2,250 for children under 18. Plus, you can claim an additional amount for the province that you live in. For BC and Ontario, the disability tax credit amount you can claim is $8,303 or $8,790 respectively. And the actual tax saving amount will depend on the provincial tax rates. If you can't use up the entire tax credit, you can transfer any unused amounts to a caregiver or a family member. Also, since this credit takes time to get approved, you can also claim up to 10 years retroactively by doing something called a T1 adjustment to amend your previous year's tax returns. And that leads me to the last thing you have to know. And that is, no matter how much you think you know about taxes or personal finance, there might still be 1 or 2 things you could do to make a huge difference to your wallet. Click here to learn the best ways to pay less tax in Canada.